Interest rates are rising, and smaller firms like startups are facing the prospect of winding up. Trade associations say half of their members are struggling to repay loans, and they're also not getting the same kind of funding that they used to. As Clara Lee finds out, this is threatening to dull their innovative edge.
To achieve its dream of a world without keys, this smart digital lock company took up 2 loans to keep it afloat during the pandemic. Now it has a new problem, paying the loans off as interest rates climb to a range of between 4 and 13%.
We are lucky that on one of our loans we are able to pay back and we are nearly done with it. On the other one, where we needed to extend the maturity date, we needed to refinance it, and we needed to put in higher interest rates so that we get our shareholder support to extend the maturity date.
These startups typically need credit to survive, and one way is through funding by venture capitalists. But at a time when recessionary bells are ringing, VCs just don't want to take more risks by investing in companies that haven't made any money. Coupled with higher funding costs, it has become the perfect storm.
There's quite a fair bit of uncertainty in terms of the macro environment landscape. Rising interest rate, recessionary pressure and stuff like that. So as a risky asset, we have seen that the volume of deals, as well as the number of deals, have shrunk year-on-year basis. In fact, based on the various industry studies, we have seen that more than 50% drop in total deal done for first half of the year compared to last year.
A sector that's feeling this particularly hard is the education technology sector. On top of having to grapple with higher rates, it's seeing a drop-off in demand when compared to the pandemic, when home-based learning was brought to the fore. The Startup Association says entrepreneurs might need to react to trends more quickly in order to convince VCs of their relevance. To help firms pivot, the association is doubling down on mentoring efforts to help them preserve cash and seek growth opportunities.
At our end is to see how we continue to support the startup and see how they can review their business model, look at their cost structure, and tide over this difficult period. And of course, the other aspect is also, despite the challenges, is to look for growth opportunity within Southeast Asia, within Asia, or even other regions.
For Igloo, it's dealing with the cash crunch by reducing overheads like cutting office space, consolidating warehouses, and stretching every dollar they've got.
As we think about our growth forward in 2024, 2025, we want to avoid taking loans as much as we can, right? I think it's important for us to get into a self-sustaining mode, get into cash flow positive, get into profitability, so that as an organization, we are in control of our own destiny.
The firm hopes restructuring supply chains will help it pull through this difficult period and get it back on track to reach full-year profitability.
And for more, we're joined by Jeff Ng. He's Head of Asia Macro Strategy in the Global Markets and Treasury Department at Sumitomo Mitsui Banking Corporation. Jeff, thanks very much for joining us. I just want to take this conversation into the larger picture. Give us a sense of what happens when firms, not just startups, SMEs, start to fail to pay their loans on time, and what kind of impact would this have on the larger economy?
Sure. I think there's likely a chain effect, because if a single company do not pay on time and winds up after having bad debts, the suppliers, for instance, they are then not able to receive the proceeds for supplying all the goods. So in the end, they will have cash flow issues. At the same time, I think employees of the various companies will also be affected. So just based on this simple example, it leads to a chain effect, which is called like contagion, which could also cause many other companies and employees to be affected. So this in turn can affect consumption and lead to an overall economic downturn.
Jeff, it's that access to cash flow which would be critical to these companies. At what point do you think the government might even have to step in with measures, perhaps, to keep those businesses afloat?
Well, I think it depends on how bad, the current interest rate situation will likely be. I think for now, interest rates have spiked up to become quite high compared to the past few decades. But I don't think it's going to get much worse from now on. And I think a lot depends on, for instance, the economic outlook for the coming year, whether the US economy is going to go into a hard landing or soft landing, or whether other economies are likely to help to bear the brunt of the slowdown.
Well, if what you're saying is true and interest rates remain at this level, businesses are being forced to refinance and take loans or mortgages with floating interest rates, how much will this affect their cash flow, right? For instance, we're talking about real estate trusts and other firms that are heavily reliant on debt.
Yes, I think there's definitely this impact because whenever interest rate increase, the amount that companies spend to finance their loans increases, and that indeed decreases profitability. So, for instance, many investment projects may get delayed because of the higher opportunity cost, and I think that may also dampen on future growth as well. So, I think overall it does mean that there's likely some continued challenges as Singapore continues to experience very tough and challenging growth conditions this year, even as we expect some better conditions next year compared to that of this year.
Jeff, the impact of these high interest rates is being felt unevenly depending on which sector we're speaking about and even the size of the firm or business that we're speaking about. Are there ones that might be more susceptible, however, to price pressures like this should global interest rates continue to stay high?
Yeah, I would imagine that the capital or resource-intensive industries will likely face the most pressures because these are the industries that require most heavy debt financing in order to keep their businesses going. So this could include the technology sector, the real estate sector, and other investment-related sectors. However, I think on the flip side, there's also other sectors that could benefit. For instance, the financial services sector. So yeah, I think as usual, whenever there's some trend, there's always some that benefit and some that suffer. But overall, a higher interest rate could cause economic growth to still remain below trend for the time being.
Jeff, we want to thank you for your insights on this issue. Jeff Ng there, Head of Asia Macro Strategy at Sumitomo Mitsui Banking Corporation. Thank you very much.